Gold investment within retirement accounts is rising, with self-directed IRAs holding over $50 billion in assets, according to recent data. Amid inflation fears, many investors are looking to hedge their retirement portfolios by converting 401ks to gold IRAs. This process involves rolling over funds into a self-directed IRA, enabling investment in IRS-approved precious metals. The transfer process begins with choosing a reputable gold IRA custodian, as traditional 401ks typically do not allow direct gold investments. Funds from your 401k can then be rolled over tax-free into the new IRA, avoiding penalties if handled correctly. Approved assets include gold coins and bars meeting purity standards, purchased through specialized dealers. Proper storage is mandatory, often requiring secure vaults or depositories. The benefits of such a transfer include diversification and protection against stock market volatility and inflation. Gold tends to retain or increase in value during economic downturns, making it a reliable safeguard. Additionally, a gold IRA offers the same tax advantages as traditional IRAs, allowing tax-deferred or tax-free growth depending on the account type. However, drawbacks must be considered. Physical gold incurs storage and insurance costs, and gold IRA custodians often charge higher fees compared to traditional IRA accounts. Gold investments do not generate dividends or interest, limiting their growth potential compared to equities. Liquidation can be slower and potentially less profitable, depending on market conditions. Additionally, gold prices can be volatile and may decrease over time, posing a risk to long-term savings. Investing in gold should complement, not replace, a diversified retirement portfolio. Most experts advise allocating no more than 5 to 10% of total assets to gold. Carefully evaluate custodians, costs, and market conditions before proceeding. Transferring a 401k to gold requires strategic planning and should align with your financial goals and risk tolerance.